Hello, everybody, and my name is Ilya. I really appreciate the opportunity to present to you today. And the subject which we'll be discussing is using macro news events in automated FX trading strategy. It's an interesting subject, but before I start, I'd like to propose something. If you have questions, actually don't wait till the very end. Ask me as we go, because it's getting late and probably you're getting tired. So it may be keeping you a little more agile. So I'd like to have this more interactive as opposed to just presenting something. And the subject of my presentation is this. Basically the main thesis is clear. Arrival of macroeconomic news from the world's largest economies brings additional volatility to FX market. That's kind of the hypothesis, which is obviously intuitive. And what we're going to do basically proof or disprove this hypothesis, and then at the end I'll create some basic automatic strategy, and we'll see how it performs. In basic terms, this illustrates what our users do. And like Stuart said, it would have been great to try it in action, but we didn't. So of the raw methodology in this slide, source of data is, right now you know, RavenPack Macroeconomic News Database. We also have access to historical tick data. In this particular case, from CTFX, we're recording this data from January of 2012. It's tick by tick. Raw, basic, very high quality market data about FX trading instruments. What we use from technology side, we have a database called Timebase, which allows us to store terabytes of data and work with it and slice and dice it. So we loaded RavenPack data to Timebase. We use our main protocol QuantOffice for doing research, and we also simulated it through paper trading in a strategy server. So what we did, couple of obvious steps. First of all, we obviously load all the data and create all the setup. Then we analyzed the RavenPack data, and we asked question, true or false, there's some clusters. With it, obviously, you can imagine this millisecond timestamp data could arrive in continuous stream, or there's some kind of clustering of data. We'll see it, and we'll call it volatility intervals. And then we analyze the distribution of this data and study the hypothesis. And as a result of this hypothesis, we produced extremely brutal, simple trading strategy. So basically, news analysis in Timebase looks like a bunch of rows and columns, but it's just all real. And tick data also pretty much clear on the right side, just spreads, best bid, best asks, and millisecond time-stamped information. And so the first experiment we did, we looked through all this data, and yeah, I forgot to mention something. It's kind of relevant. That amount of data is actually quite large. So there was around, from period which we analyzed from this particular experiment, originally was done in 2012, from March until September of 2012, we got around 100 million messages for tick data, approximately a million per day. And also the data from RavenPack, of course, was also not small. And so what we've done, we took 1 minute time intervals. We wanted to understand if there is a predictable pattern, if data is clustered into 1 minute time intervals, and we just filter everything with relevance 100 and novelty score 100. And so what we found is what you would expect. There's definitely some clearly defined volatility zones based upon the countries. So if I just slide quicker, this is the picture where you can see the color codes and the spikes of news. And bottom line, that there's indeed some periods which would be expected, like 8:30 in the morning, or 10 o'clock in the morning, or 2 a.m. for Japan. They're all pretty predictable. So what it means that we're going to ignore all the news factors outside of volatility zone and only focus on volatility areas which we would be studying. So at this point, you can even ask question, why RavenPack? At this point, it's just more like an economic calendar. And indeed, there was definitely a case where you can make just simply, as a data source, any economic news calendar. So how do we study impact of release of news statistics on short-term volatility? We use two measures of short-term volatility. One, is an annualized standard deviation of log returns inside 5-minute window based upon 10-second bars. So obviously we're not doing ultra high frequency trading, but it's a relatively high frequency trading machine. We're going to live with granularity of 10 seconds. And so we took first measure volatility is annualized standard deviation. Second measure was kind of known to community of technical traders called variance ratio, which was introduced by Lowe and McKinley late 80s. The kind of factor by itself, we actually did something which is called Poor's mean volatility variance ratio, which is basically spread between high-low over 5 minutes divided by average true range. And so this is the formulas, all right? And we just run all this stuff, and every 5 minutes before a news announcement and after, we look at distributions. The good news about variance ratio is that if it's greater than 1, then it assumes that there's a trending because of autocorrelation. If it's less than 1, then it's a random walk with kind of mean reverting kind of pattern. If it's 1, it's just completely random walk. Any questions so far? Good. So I'll move on. Just experiments, right? I mean, as expected, or not expected, I wouldn't be here if I would be not finding the impact of macroeconomic news on short-term volatility. So the tables, just a lot of numbers, but bottom line, what actually happens is that they numbers representing the case where if news announces, then volatility change much higher than there's no news. That's kind of the basic observation within the same volatility areas for US and for Japan. And visually, it looks like this, right? That I don't have a pointer, so I'll use my finger. It's all right, if you don't mind. So right here, news was announced around 8:30. And this curve representing the standard deviation, which is, I mentioned, one measure of volatility. This curve represents the variance ratio. It really literally jumps from 1, which is random walk, to some kind of distinct trending pattern. And it's actually quite interesting observation. So in this example, where we're going to see repeatable and repeatable patterns where when news gets announced, the spikes of volatility more pronounced than outside of news. So this example shows you the distribution of previous variance ratios. And if I just literally make my cursor move, you can see how it shifts back and forth. So you can see basically it's previous, next variance ratio. So that means that volatility definitely jumps when news get announced. Great. So because of that, we said, if there is a volatility increase, let's take advantage of it. And let's build the probably dumbest, but the most simple trading strategy based upon that fact. So what we've done, we said, all right, so because variance ratio in most cases is greater than 1, that means there's a trending. So we're going to create a breakout strategy. We're going to take the price at the bar close when news announces. We calculate high-low spread in the previous 5 minutes, and we'll create the barriers, one or whatever ratio above and below the current price. So we create breakout levels. If price breaks through that, if it breaks at the top, we're going to go long. If it breaks down, we go short. That's it. And we're going to wait only 5 minutes from a moment when news was announced, and we'll close our position 5 minutes after. That's the strategy. And as a result of this strategy, this is the typical use case where I'm just explaining it, right? This is a news. We're creating this bracket. When price broke through, we're going short. 5 minutes later, literally from 8 to 8 to 5, we're closing it. In this case, we made a few bucks. So this is just in the proximity, the close distance, that's how the whole thing looks. It's 10-second intervals. If I look at a strategy over 3 months, that's pretty much how it looks for every instrument. I mean, good news, the quant office can handle this type of stuff, so I'm obviously, it was really cool research. You can see the spikes in standard deviations, volatility ratios, this P&L curve for one instrument. This is the backtesting of this strategy from March until July of 2012. And we see this curve, right? Would I trade this curve? Probably not, but it's not bad. Because if you make this curve without any efforts, the strategy itself had an information ratio, which is the most important thing, around 2.9, which is not bad. And it had a relatively reasonable average profit per share, which is, even though we're using Forex, it was definitely more than 1 pip, which you use usually as a spread. However, in this picture, right, there's nowhere any enhancements, we're basically taking the calendar data and trading it within 5 minutes. And we saw this big, obviously, drawdown, which nobody likes, and that's obviously what is the biggest fear of all the automatic strategies. So we decided to see if we can enhance the strategy by using one only factor from RavenPack called ESS, right? You heard about today, this event sentiment score. And so we've analyzed the speed with which variance ratio changes. So we created the second measure. We said, true or false, that depending on ESS, the variance ratio would be changed more dramatically or not. And we basically took all the ESSs and grouped them by thirds and found the interesting pattern that events with low and mid-range values of ESS trigger larger short-term volatility growth than news events with high values of ESS. It may not be a predictable pattern. We just found it during this window and took advantage of this, and we basically filtered all high ESSs, all events of high ESSs, and the resulting strategy looks much better. It basically didn't have big drawdowns. It still had, of course, some drawdowns, but this curve deserved to be presented to you guys. And so the Sharpe ratio, or information ratio, kind of the same thing, is around 4.7 in this interval, which is already something to think about. So we've done this all in 2012. Well, now 2014, we got new data. We took the data, we uploaded it to database, and decided to run call test, literally like what's called out of sample, right? I just basically run the strategy. This would happen without filters. We can see unfortunately, this massive drawdown. If I didn't have it, strategy would have been fantastic, but I had it. Still, it was okay. If you can tolerate this drawdown. But applying filters, we've got this curve, which seemed, again, relatively smooth and presentable. And so summary of this particular experiment, we got Sharpe ratio of around 5 and information ratio. The difference between them is because we calculate different annualized returns. So anyway, it's around 3.5 information ratio. So what we've got at the end? We've got a story which I present to you that, first of all, macroeconomic news definitely increases short-term volatility. Second, that the even simple breakout strategy had some potential. It could be definitely enhanced if we apply risk and additional condiments. We maybe make a good dish out of it. And filter definitely used to improve the performance. It just helped us. And finally, that out of sample backtesting for the period from March 2013 until October, which is 6 months, basically we got additional evidence that the strategy has some potential application. So that's kind of the story which I want to tell you. I hope you found it useful.
I would just like to comment that I find it statistically significant that nobody took Ilya up on his offer to ask a question during the presentation. Now is your chance that those of you who didn't find the time to do so, now is your chance to do that. Any questions about this? Or comments even, actually. One of the things we find when we do this sort of thing, we do reasonably often, is that somebody who does trade will say, that's who,
Sir, there was a question right in the front row.
Oh, so I'm sorry.
So we should go probably.
I'll come back in a second.
So it doesn't have to be a question, it be a comment. Yeah, two questions. So first of all, what do you assume regarding the prices at which you enter and exit your positions in the simulation?
Mid price between best bidder, best offer, and the breakout was set up 1.25 of spread between high and low within previous 5 minutes.
Do you penalize yourself at all for trading costs, or do you just assume?
No, this particular, no, I don't penalize, but because I basically look at like I said, average profit per share, which is, I didn't penalize. It was more like ideal execution at this point.
And then another question is, what kind of data does CFX have? Does it aggregate?
No, just one second, I'll tell you though, but I executed on best bid, best offer. So I actually, signal was based upon mid price, but the field price was, I was buying at lowest price and selling, just opposite, buying at the ask and selling at bid.
Oh, so it's like a market orders.
Right.
Okay.
CTFX has three different products. One of them called TradeStream, and that's the kind of mid-market product which we aggregate their own prices ourselves in our data center. So pretty much it represents the 20 or 30 world currencies, and it's just we're recording every tick, every bid, and every ask. So it's not their data, it's our data.
It's about 7 liquidity providers that they aggregate. That's
Like 7 dealers?
7, yes. If you ask them, they'll tell you, but it's about that number.
That was a question.
I want somebody to challenge rather than ask a question. You get a challenge, sir?
A little bit. Ilya, nice presentation.
Thank you.
Yeah, well, suggestions maybe, I guess. It seems like your presentation basically shows the incremental value of the sentiment data. And it'd be interesting to see that on sort of broken down by an event basis. You can imagine like hit ratio type of approach or something like the median trade, what's it look like type of thing. If you can say anything to that, that would be interesting. The other thing I'd be interested to know more about is, well, what's the trading strategy? How many currencies are being traded?
Yeah, right now.
What is the setup there?
Yep. Right now there was three currencies, basically three main ones: Euro USD, Pound USD, and Euro USD, and I'm sorry, Euro USD. What? Euro USD, Euro Yen, and Dollar Yen. That's what it is. Sorry, I just couldn't pronounce it. And in terms of breaking out onto categories, RavenPack has a lot of different categories, and I got lost in this. I also had the same kind of desire, but I decided to just filter by 20 most active message types, and we didn't break out by subcategory. It would be definitely interesting, but I'd rather you guys do it. Me just presenting the underlying methodology, because anyway, I'm not going to use it at this point for anything more than just presenting.
Even with the 4 sharp
I have a question.
Even with the 4 sharp ratio?
Well, yeah, I mean, I'm a software vendor, right? So at this point,
Maybe you should become a trader.
well, that's a good suggestion. That's a bigger one. And that's advice I can actually respect.
I have
Yeah.
a question on how you're calculating the Sharpe ratio, the denominator. How are you calculating the standard deviation? There are only discrete events occurring in your strategy, correct?
Well, Sharpe ratio, no. Sharpe ratio, I just basically look at
Daily.
I look at the just daily P&L and calculate annualized return, annualized volatility, and I use CAGR as a measure of return. If I use information ratio, it's easier because then I look at absolute returns, absolute volatility. Well, that's why there's discrepancy. But anyway, I just use daily statistics like a normal Sharpe ratio. I mean, just look daily. It's daily cutoff points. So there's no kind of magic in this case.
All right.
There's a question. Okay.
My question would be, do you assume zero latency and infinite liquidity? In other words, you assume that if you see the price and decide to trade, you get this price?
Yeah. In this simulation.
How realistic is it for the platform?
Well, in this particular case, I was buying at ask and selling at bid. So basically almost crossing the spread. And latency, I mean, it's just not high frequency trading strategy. It's basically wait for 5 minutes. So I don't know. I mean, I could definitely simulate it, but in this case we didn't. Yeah, there's a question.
So did you try filtering out by, so Macroeconomic News also have professional forecasters looking at it, and you can calculate, I guess, the surprise of the news by looking at the actual announcement minus what the professional forecaster predicted. So do you try filtering out by that versus
No.
RavenPack to see if you get different results, or whether it's...
I'm sure we'll get different results. I have no doubts about it, because even when we did the simplest possible grouping by ESS, we got different results. If you filter like top performers versus, top ESSs, but we didn't. I'm not an expert, unfortunately, in RavenPack data, so all I did just survived this particular experiment.
You were asking for challenge.
Absolutely.
So if we could roll back a few so that daily chart.
You tell me when you wanted me to.
Okay, there is a chart of Euro-USD in May 2012.
Yes.
I recognize by trading as a Greek default situation. Just if you, and then you
What do you
got
mean?
spike in volatility, which you said was profitable for you.
You're talking about this chart? This is German.
The one before me. Yeah, that's it.
No. Before it will be no trading.
Okay, I guess a little further.
Yeah, probably further.
Anyway,
This is not enhanced strategy.
The challenge is because the example seems to have been chosen to capitalize on volatility and you made money, but that was Greece going into default situation. That's why volatility blew out.
Well, what about this
So
one?
it
There's
was
no
easy
Greece.
to make money at that time.
This is 2013. There's no Greece here.
No, in 2000. This is excellent. The one before I think was 2012. Okay. So anyway, congratulations.
No, it's not. No. Look, the difference between this strategy and if I made it for real, with my own money in the bank, that would be a different story. Then I would just say congratulations. No, but that was a good experiment. All I was trying to say that there is something hidden in RavenPack data, which in not my hands, but in somebody else's hands, may be put to work. That's all I said at this point. Definitely, trust me. Well, I would say that I'm pretty sure if I run it for a longer period of time, there will be some drawdowns like this, even with my filters. So I know for sure that there's a lot of pit holes in all this robot-based trading, and you need to do more than just simply take a simple breakout strategy. All right.
Any other questions, comments? I would say that we're software guys, not traders, and I would ask you not to encourage him to change that. Change that. Thank you. Thank you, Ilya.
Thank you.